Hi, Eric Mattingly here, and welcome back to our next Wealth Building Strategies workshop series, Real Estate in Your Retirement Part 2. Today, we're going to be covering one of my favorite topics, which is investing through a self-directed IRA. And I'm going to be going over some advanced self-directed IRA investing strategies. So this is our 201 module of the self-directed IRA investing series. Again, DMI Holdings, we've been around since 2008, based in Dallas. My partner, Leon Chastain, and I are the owners of DMI Holdings, and we provide passive investment opportunities for individual investors. We've been involved in a little over $1.5 billion in investment transactions, totaling a little over 100 private placement offerings from 2008 to present. So let's jump into it. There's a lot of different self-directed retirement plans, all retirement plans can be self-directed. So for example, you can do IRAs, traditional and Roth IRAs can be self-directed, precious metal, traditional and Roth, traditional 401ks and solo 401k or solo Ks, 401k Roth, solo K Roth, simple IRAs, SEP IRAs, education savings account, and healthcare savings account. All of these types of retirement plans and savings plans can be self-directed, that you can control and invest in things that you know and trust and are comfortable with outside of stocks, bonds, and mutual funds. So now that you've gone through the first workshop, or you're already familiar with and educated on self-directed IRA investing, and you want a little bit deeper understanding, that's what this workshop is designed to cover. So I'm going to talk a little bit more about this. Unrelated business income tax is called UBIT. So many people get hung up on this. It's very, very complicated. And quite frankly, if I get a good return on my investment, I could care less about unrelated business income tax. I had a lady come up to me one time and she said, oh, I just, hate multifamily because I had to pay unrelated business income tax. And I'm like, so did the property sell? Yes. What kind of return did you make per year? About 20% per year. Okay. And so you had to pay a little bit of tax because you don't get taxed on the whole amount. You only get taxed on a portion of it. And so there was actually very little tax that she had to pay, but she had it in her mind that because it triggered unrelated business income tax, and it sounds very technical, I mean, just don't get too wrapped up in this. And you're going to see what I mean when I go through this, because it's very confusing. All I can tell you is if I make a 10% or better return on my money, I could care less if it triggers unrelated business income tax. I'll pay my tax and then go invest in other things, continue to grow my money tax deferred, and take my money out tax-free because I use a Roth. So unrelated business income tax, it's income derived from any unrelated trade and business that was originally organized for. I know I covered this in the 101 series, but I'm going to go into more detail here, and it's just simply going to be more confusing. And again, don't get any brain damage over this. It was originated with the government dealing with tax-exempt organizations, and unrelated debt-financed income may cause income generated to trigger unrelated business income tax. If you're investing in an apartment complex and there's debt on there, it could trigger unrelated debt finance income, which could then trigger the unrelated business income tax. But again, the tax is not that bad. And if you make a good return, who cares? Most passive investments are exempt, and the case history is very shallow as it relates to self-directed IRAs and unrelated business income tax. Calculations are done on sale, and they'd be included in the K-1 to your self-directed IRA custodian. And every taxpayer situation is different. So you need to consult with your CPA and have them evaluate, and then they can tell you what you may wind up having to pay or not pay. It depends. There are deductions that you also can get that will help to offset some of those things. So you need to consult with your CPA on that. So getting hit with unrelated business income tax depends on the type of investments you do. Again, just consult with your CPA or tax advisor for your specific tax situation. But let's go through a few of the clauses as it relates to UBIT. The purpose of UBIT is for defining and segregating what additional income that does not belong to the main portion of the organization that it was intentionally organized for. This concept first came about with the government's dealing with tax-exempt organizations and has bled over into the self-directed IRAs, since they have a tax-deferred structure that is often looked at as similar to tax-exempt treatment status. Most of the issues and treatments come from the issues in history of tax-exempt organizations, as the research and case history for self-directed IRAs is very shallow due to their young existence. A large amount of whether the treatment of self-directed IRAs is subject to UBIT tax is subjective and will depend upon the managing member's interpretation of their business in relation to the Internal Revenue Code. If UBIT rules are triggered, then the income generated from those activities of the unrelated business income tax will generally be subject to taxation. Most passive investments that your self-directed IRA might invest in are exempt from UBIT, but not all. IRA investing in an active trade or business using a C Corp will not trigger the unrelated business income tax, as it is already subject to the corporate taxation. Remember, IRAs can't invest in S Corps, but you could invest in a C Corp. Some examples of exempt types of income include dividends, annuities, royalties, most rentals, interest from loans, hard money loans you may do out of your retirement plan, gains, losses from the sale of real estate. When an exempt organization such as an IRA undertakes any development activities in connection with the selling of real estate beyond passively placing the property for sale, either directly through a broker, the issue arises under Internal Revenue Code 512B5A, whether the real estate is properly held primarily for sale to consumers on the ordinary course of the trade or business. An organization that engages in the sale of property to customers in the ordinary course of the trade or business is characterized as acting as a dealer. There are three concepts that must exist separately for UBIT to be a concern for an organization. UBIT must come from a trade or business. The trade or business must be regularly carried on, and the UBIT must be unrelated to the initial purpose of the business. Income from a trade, unrelated business income tax income is as follows: income from a trade or business, business income generated via a pass-through entity, LLC or partnership, using non-recourse loans to purchase properties, using margin on stocks to purchase. Then there's also what's called unrelated debt financed income. Some examples of unrelated debt financed income include debt financed property for the use of producing income, rental property, multifamily property, strip center, that type of thing. Income from the real estate investment that is treated as a business inventory instead of as an investment. Unrelated debt finance income refers to borrowing money to purchase the real estate. In such cases, only the income attributable to the financed portion of the property is taxed. So $10 million deal, $3 million is equity, $7 million is debt. The only portion that could receive any unrelated debt finance income or be classified as unrelated debt finance income would be the $7 million out of the 10, not the entire $10 million deal. The gain on the profit from the sale on the leveraged assets is also unrelated debt finance income unless the debt is paid off more than 12 months before the property is sold. Rental income generated from real estate that is leveraged against debt losses, the exclusion from UBIT, this portion of your income becomes subject to the unrelated business income tax. So again, $10 million deal, $3 million equity, $7 million of debt. You might contribute $100,000. So, $70,000 70% of the returns you are going to get are a result of the debt being used to leverage up the equity. So that would be the portion that would create unrelated debt financed income potentially, but not for sure. And that would be the part that may be subject to unrelated business income tax. But again, as I shared with you, this stuff gets pretty confusing. And quite frankly, as I said, as an investor, all I care about is getting a good return. And as long as I get a good return, if I have to pay a little bit of tax because of some of these rules or something is triggered, I just quite frankly don't care. We had a multifamily property I invested in, my IRA, held it for 7 years. All of my money was sent back to my IRA after about 3.5 years from refinance. We were able to pull 100% of the equity out. My IRA still continued to get distributions. And then when we sold the property, overall, between what I had been distributed and what I got in a gain on sale, annualized out to 40% per year. Did I pay any unrelated business income tax? If I did, I didn't care and I didn't even notice it. So again, it just goes back to invest in things that you can get a good return. And if it happens to trigger one of these things, then just don't worry too much about it. Roth conversions, we talked a little bit about that. So prior to 2010, as I shared with you in 101, you could not contribute to a Roth. If you could not contribute, you couldn't convert. 2010, the laws changed and anyone at any income level could convert and taxes could be split over 2 years. So you may not be in an income tax bracket that allows you to convert to allows you to contribute to a Roth IRA. However, if you have a retirement plan and you want to do a traditional to a Roth conversion, even though you may not be able to contribute, you can still convert. So it does give you the option to move money from a traditional retirement structure over to a Roth. And we'll go over a few of those strategies. I talked a little bit about it in the last one. So if you're going to convert to a Roth, and you can't contribute, and whether you can or can't, and you want to convert part or all of your retirement plan, you need to think about a few things. But number one is, remember, you only pay tax on, you only owe any taxes on the value. So if possible, get the investment valued for less than what you invested, then convert it to a Roth. Taxes are owed on the value at the time of conversion, not the original investment. So it's very important that you understand that, because you could minimize significantly any tax liability you have moving money from a traditional to a Roth if you're able to use some of these techniques. Only invest in assets that you can protect against loss, buy at a discount, or be able to create value. A few mistakes we discussed before, but uneducated investors sell volatile investments, then convert to a Roth, pay the taxes due from inside the Roth, reducing their investment capital, then go right back into more volatile investments, effectively compounding both their tax loss and their investment loss. So you need to be careful, and I'm going to show you some examples here in a minute on some things you can look at doing. So these are your most common mistakes: taking a tax loss, then reinvesting and having an investment loss. Second thing is just not understanding why to convert. So you don't just convert to a Roth because all of a sudden you're allowed to convert to a Roth. If you're not, if you don't have any real strategy in mind of what you're going to do once you convert it to a Roth, again, if you just exit out of mutual funds and or even just transfer them in kind over to your Roth IRA, you're going to pay tax on whatever the value was at the time. And then if the value then goes down, now you've had tax liability you just triggered and an investment loss. That's not a very smart strategy. Also not understanding the value. You're not going to be able to get a stock valued for less. However, there are some strategies with regard to stocks and converting to a Roth, where if you, for example, watch a stock, 52-week trading average, and let's say it's trading at $50 a share, and then all of a sudden it drops down to $25 a share, but it's a stable blue chip company. Well, you're probably safe to convert that to a Roth because it's on a discount, and then go over, and the likelihood that it's going to come back up to its 52-week trading average is very high. That would be a way to do it if you're a stock market investor, or if you have mutual funds or what have you, to help to mitigate a little bit of that volatility, is wait for it to go on sale, then convert. So at least you have a good chance that it's not going to lose any further value once you convert, because you are going to owe the tax. You might have invested 100,000 and it's dips down to 50,000. Well, you're going to only pay tax on the 50,000, even if it goes right back up to 100,000 the day after you convert. So some things to think about when you're ready to make that switch. And also not understanding what your basis is. So a lot of people that have money in the market, they will look at their statements. Oh man, my stockbroker, my financial advisor made me, 10% this year, but last year they lost you 20%. And this year they didn't even get you back up to square one. They're going to have to generate you a 40% return to get you back up to even. So you need to understand, at the end of the day, it doesn't matter what you invested, or it doesn't matter what your account value is. What matters is how much money did you put in, what's the value today, and then take that amount and divide it over the number of years you've had your money in there, and that's the return you've made on it. There is no such thing as a paper loss. The value of your investments are worth what they are on any given day. And if you go and liquidate out of a mutual fund that's down, that is a real loss. So understand what your basis is. What is the amount that you invested? And then also not understanding your investments. Don't just invest in things that you don't understand. If you're just going to leave your money in mutual funds, quite frankly, it may not even make sense to convert, but it might. Depends on your age. If you have time, still might make sense, because again, you can pull that money out tax-free. There are no required minimum distributions. So there's some huge benefit to converting to a Roth. We just want to make sure you understand some of these things before you pull the trigger, if you haven't already done so. There's a strategy called Roth Conversion Recategorization. So this will assist investors in making sure that if they made a poor choice, they can actually unwind it. So you converted to a Roth, you did all these things, and all of a sudden you go, you know what, I screwed up. So here is the process and what it looks like, and you can unwind that conversion if you need to go back to a traditional structure and try it again at a later date and maybe do it with a better strategy. So this is kind of a nice feature a lot of people don't know about. And so let's just take some hypothetical dates. Say February 2023, you purchased an investment, you valued for less, you converted to a Roth, you're feeling pretty good about the tax investment strategy. Then in December, you're starting to think, well, now towards the end of the year's about to wrap up. I'm not so sure anymore if I should have done this. My investment's now worth less. My taxes are going to be on the value at the conversion. And then April 2024, still hanging in there, filed an extension, riding it out, but still upside down. Then in October, you're down to the witching hour and you realize this definitely didn't work out according to your plan. You can unwind the conversion, recategorize the Roth back to a traditional. And then in November of 2024, thank God I knew what I was doing, or would have just compounded my tax loss. Go to the bar and celebrate. You just bailed out your IRA. So the nice thing is, if you try one of these strategies with the conversion, and then at the before you close out your taxes for the year, you can recategorize your Roth IRA back to a traditional so that you do have an out. So don't be afraid to try it, because you can unwind it if you need to. You just need to be aware of the timelines and make sure you don't file your tax return. You need to do that before you file your tax return. IRA LLCs, we went over this in Self-Directed IRA Investing 101. This is a pretty controversial thing. I don't recommend it. You have a current retirement plan, you flip it over to a self-directed IRA custodian, you go and set up a single member LLC, and that single member LLC gets funded by the self-directed IRA, but you're the manager of that LLC. you're writing the checks, the IRA is not. And then that IRA is taking title to investments and receiving the income and that type of thing. If you do want to distribute to yourself, you don't do that out of the LLC. You would do that out of the self-directed IRA. So you would actually have to send money back up to the self-directed IRA from the IRA LLC to make any distributions out to yourself. So there is a lot of controversy. A lot of custodians will not allow IRAs with single member LLCs that you're the check writer. But you are the manager. LLC invests for the benefit of your IRA, and you have check writing access, and you're personally involved. And remember the rules that we discussed earlier. This may be considered a prohibited transaction, and that would completely unwind any tax benefits that you had with your IRA if that's what happens. So just be careful. And again, I don't recommend this structure. And if, you know, like I said, some custodians won't allow it. And so that would make me nervous. And I personally don't use this strategy. There is an alternative, however, and I have used this strategy. I wound up unwinding it after a period of time. It just, I felt like I was kind of bothering our attorney, my friend, who's also the attorney. But there's what's called an IRA trust. So you can set up an IRA trust. You can set up a bank account for the IRA trust. The IRA funds the trust by transferring or contributing. So here's the thing, for your IRA, this is also a great way to keep your IRA custodial fees down, because the IRA can fund the trust. The trust can own 20 investments, but the IRA fee you pay is only for one investment, because the investment, as far as the IRA is concerned, is the trust, even though the trust owns 20 different investments. So this was a strategy that I used for that very reason, so that I only paid one fee versus having to pay a fee for each asset, which is how a lot of IRA custodians operate. In this case, you personally do not have check writing access. However, your trustee does. So you would name a trustee. They would have to write checks or wire money for you when you're ready to do an investment. And in my case, my attorney was my trustee on my IRA trust. And yeah, I just felt like I was, you know, because he had to go to the bank, do a wire, that kind of thing. And so I just decided to just deal directly out of my IRA. But this is a great strategy, and it is an alternative to your IRA LLC example we talked about earlier. The only thing is you can't have a family member being your trustee. It would need to be a third-party person. But you have all the same advantages as the IRA LLC with none of the problems. So let's talk about some ways you can explode your IRA. There's some really interesting investment strategies that, especially if you're using a Roth, that you can really blow up your retirement plan. So if you combine investment knowledge with IRA knowledge, that equals a massive retirement account. So having the ability to apply knowledge and be able to identify, then monetize opportunities to a self-directed IRA can set you free real fast. So let's look at the real estate investor and some things you can do, some strategies you can do. So ask yourself, how can I buy at a discount? How can I get the investment valued for less? Then convert to a Roth. With the stock market investor, pick quality, stable companies. And I always tell people, just use the pantry test. You know, go look in your pantry. Those companies have been around forever. They're going to be around forever. Campbell's, Kellogg's, you know, Walmart, Home Depot, etc. And the father of time test, you know, Disney, Walmart, Home Depot, as I was saying. If you have the stocks, you just watch the 52-week trading average, as I was sharing with you earlier, then buy the stock when it's down at a discount below that 52-week trading average, then you convert to a Roth. This way you can protect on that conversion. Then when the stock goes back up to its average, all those gains are tax-free to you. When the stock is back up to its 52-week trading average, you can sell and then capture the gains. I know what you're thinking. Isn't that a speculative move? It's what I call strategic speculation that you can undo if your strategy doesn't work right, which is the recategorization we talked about. Life settlements is another investment vehicle that's out there. A lot of self-directed IRA custodians won't allow you to invest in a life settlement contract because it could be considered an insurance purchase, but some do. So you can purchase a life settlement contract, you can send the policy out to a valuation service. There's one called LSX Exchange. They'll provide a valuation. You can value, typically will come in at about 80% of the invested amount, giving you a slight discount, provided that the valuation is immediately after you purchase it. The longer you wait, the higher that valuation is going to go with a life settlement contract. Then you go and convert to a Roth and then enjoy any of the gains tax-free. Real estate investor with real property. So the property value is $150,000. You can purchase a property for $100,000. You can get a broker's opinion of value for $70,000 or less, then convert that to a Roth, sell and double your money tax-free. You can also invest in notes. Property value is $150,000. Purchase a note at $50,000. The note goes non-performing, meaning that the borrower stops paying, but you have your loan secured against real property. So now that it's non-performing, you can go get a professional opinion of value, which is going to be less than what you lent. Then you convert to a Roth, note goes performing again, and then you can sell and double your money or more tax-free. Fixing and flipping homes. You can use this strategy. So you have a managing partner, you got a debt partner, an equity partner, real estate, hard money loans with a twist. So you can convert, I'm just using this as an example, $20,000 to a Roth. You can become an equity partner for a fix and flip investor, charge a 20% service fee versus an interest rate or a percentage of profits. 18% is the maximum legal interest. So this is not an interest rate. This would be a service fee. I have a investor friend of mine that does this all the time, and he grew his IRA to over $10 million doing this exact strategy to people that fixed and flipped homes. And he was a hard money lender to people that flipped homes. And he would charge a service fee, and it was for a 6-month period of time. If the loan needed to be extended for another 6 months, then he would charge another service fee for another 20%. So you could imagine what that did for his IRA. Most fix and flips take longer than 6 months. Service fee avoids the usury laws. Do that twice and you annualize 40% ROI on your investment tax-free. And that's exactly what my friend does. I can also do assignments of contracts. So let's say you convert $5,000 to a Roth. You have a property that's valued at $150,000. You negotiate a purchase at $100,000. You put $3,000 down in earnest money from your IRA. You make sure the title company deposits the earnest money. They have to cash the check. So there has to be an actual transaction that happens inside of your IRA for this to work. Then you assign the contract to another buyer for $110,000, which is easy to do if it's worth $150,000. Real estate investors do this all the time. Now your Roth just made a 200% return. So you invested $3,000, you got back $10,000 with an assignment of contract strategy inside of your Roth IRA, all tax-free. Get some experience, then do some deals. So again, you have a few different options. A lot of transactions, you're going to have a debt partner and an equity partner. Then as you grow, you can start increasing your, and that's a structure that's typically used on a fix and flip. If you start becoming successful and you want to do multiple transactions, you can set up an LLC. And there's a manager of the LLC, and now your investor is wanting to do more transactions. You can invest into their LLC, allows them the ability to do multiple transactions simultaneously. So the real estate investor LLC strategy, convert $500 to a Roth IRA, set up an LLC with partners, meaning that the partners put the LLC together, not you. You're not a member in the LLC. You set the value in the operating agreement at $1,000 prior to conducting any business. So your IRA then invests, but before any business activity goes on, you can set the value of that LLC at whatever dollar amount you want, quite frankly. Then let's say your IRA owns 20%, then you're going to buy in for $200. Then let's say the LLC, as you were seeing in the example before, we were working with people fixing and flipping homes. Let's say it generates $1 million that year in profits. Then your $200 investment just generated a $200,000 gain with your 20% ownership by setting up the structure that way. You can originate an LLC and do this yourself. Just keep in mind that you can't compensate yourself out of the LLC. If your IRA is an investor, you can manage and oversee the activities. You just can't compensate yourself. So this is a powerful way. Just having a little bit of knowledge and strategy goes a long way. So your Roth IRA in this case makes a 100,000% return on investment tax-free. I've seen some pretty incredible things with some pretty huge numbers that have been done inside of IRAs. I've never made that great of a return, but I haven't used this strategy for my IRA, but I have used quite a few of these strategies and made substantial gains inside of my Roth IRA. And with that, I hope that some of this information opened up your mind to some ideas on how you can compound and grow your retirement plan with some advanced self-directed IRA strategies. If you want to connect with us, you can text the word passive to 66866, or you can go to our website at investwithdmi.com. Our main number is below. You can reach out to us by phone, or you can email invest@dmi-mgt.com. With that, I want to thank you, and I enjoyed sharing the information.